Investor's Guide. You're watching ET now, and I'm so glad you joined us this week. This is a show that helps you find the perfect investments in the market and helps you build a perfect portfolio. This week, I'm focusing on those of you who are closing in on 40 and you still haven't started making a full financial plan. You know who I'm talking to. There's no judgment for you here on the show. Like I keep saying, it's never too late to start. We're going to start today. We're going to make a plan for you. You'll start right now and you'll feel much better about your money by the end of the show. You can write to us. Email ID is at the bottom of your screen. Send me any question you have about your money. Let's get straight to it. We'll start by telling you how you can plan ahead and be financially prepared for emergencies like layoffs. We help a woman investor strengthen her portfolio and secure her child's future. And in our product review this week, we're looking at the HDFC Tax Saver Fund. Alright, so let's get started. Now, in this weak economy, I know that a lot of you live in perpetual fear of being laid off at work. It doesn't matter how hard you work, there's often nothing you can do when that cost-cutting demon comes knocking. But if you plan ahead, you can make sure that your investments and your finances are ready and you can buy yourself at least 3 or 4 months' time to find a new job. All it takes is 4 very simple steps. Here's a look at how you can make yourself worry-free. In a world where the words slow down and cost-cutting are becoming part of our daily lives, layoffs are becoming a reality. A job loss is a scary situation for anyone, whether you have obligations or not. And for those of us who do have loans to pay back and family members to care for, planning ahead can ensure financial stability. There are 3 simple steps you can take to be better prepared. Start by creating a contingency fund of 3 to 6 months of your expenses. Buy an individual health policy and a life cover. And finally, track your Provident Fund account. Let's go through this list one by one. You need to start by making a list of all your daily expenses and formal commitments so you know how much money you need in your contingency fund. Your list should include rent, EMIs, school fees, bills, and entertainment costs.
It's typical to have about 6 months of all your expenses, your living expenses, your EMIs, your insurance premiums, all of them put together is what you would multiply that by 6 and that's what you would have as a contingency reserve.
It also makes sense to reduce your debt as far as possible. Pay off all your loans, starting with your credit card and personal loans to your auto and your housing loans. Don't be afraid to liquidate some of your assets to pay off your loans.
If you have certain assets, like for example, if you have fixed deposit which is yielding you 8 or 9%, and you have outstanding home loan which is costing you 10-11% or car loan, then try and liquidate portion of the fixed deposit and pay off those loans. What will happen is, one is you'll have lesser burden of loan tension, as well as your EMIs would come down, so your contingency fund requirements will come down.
Once you have the money for your contingency fund, don't leave it sitting in your bank account. You should move that money into an investment that will yield strong returns, keep your capital safe, and allow you to pull the money out when you need it. Which means you have to choose between a fixed deposit and a debt fund.
Fixed deposit will give you a assured return, but the interest that comes to you is taxable. Mutual funds would have a return which are a little variable, but there is a dividend distribution tax, but the money in your hand is tax-free. So based on what tax bracket you are in, the surety of income that you require, you choose a debt fund.
The next on your list is your insurance covers. Now, most of us rely on health insurance provided by our employers. But is that cover enough? And what happens if you lose your job? Having an individual health policy is an absolute must. If you live in one of India's big cities, you need a cover of at least 5 lakh rupees. And if you live outside our metros, then a cover of 3 lakh rupees should do.
Today, health insurance provided by employers is under increasing threat. The cost is going up. And because cost is going up, employers are cringing on the benefits that are available. One, or they are limiting the amount. So therefore the cover may be there, it may not be enough. This is even while you are there with the employer. When you change jobs, it's not necessary that the new employer has a health cover or that it is sufficient.
Understand all the perks your employer gives you. If a life insurance policy is one of them, make sure you buy an individual cover as well. If you're the breadwinner of your family, your life cover should pay off all your outstanding loans if something were to happen to you. The last thing to keep in mind is your Provident Fund account. Experts recommend you keep track of the balance in your Provident Fund account every year. You can easily find all of those details online.
If you are not likely to get another job or already 6 months have passed and you haven't, although you had thought you would but you haven't, and now it looks unlikely, then you need to plan for the CPF money. Possibly you should withdraw it.
Now, armed with this list, plan ahead for any unexpected job loss. It does make sense to sit down with your family and your financial planner and chalk out your risks and plan your contingencies together. Alright, I hope you got that down and you can write back to us if you need more help with that plan. Now we bring in Virendra Kumar, the CEO of Value Research and our in-house mutual fund expert who joins us every week. Virendra, thank you so much for joining us.
Thank you.
Let's get straight to our portfolio versus portfolio question that's also this week from a woman investor. Well, JAYALAKSHMI Shankar has written in. She's 39 years old. She works in Bangalore in the IT industry. And she tells us she has a 3-year-old son for whom she's doing a lot of planning. That she has a 3 lakh rupee term cover. JAYALAKSHMI, I can tell you right now that's not enough. You need 10 times your annual income as your term cover. So does your husband. So make sure that's the first thing you do right now. Virendra, 48,000 rupees going into the PPF along with 3,60,000 rupees in bank deposits that will mature next month. She also has an LIC policy with a 1 lakh rupee premium every year. She's unhappy with that policy. She wants to pull it out. She has 3 main goals. She wants to plan for her son who's going to start schooling next year. So she wants about 3 lakh rupees set aside for him. She wants to pay off the loan she's taken to buy a plot of land in Bangalore. It's about 10 lakh rupees pending on that. She's also planning to take another loan to start construction in the next 2 years. And she has her son's higher education and her own retirement to start planning for. Now, she was a little upset that she's starting so late, but like we keep saying on this show, it's never too late to get started. Let's start by prioritizing her goal. What should she put on the top of her list and what should she tackle first?
The first is that, keep the money aside which you need 1 year from now for getting your child admitted. That is something which is non-negotiable. And number 2 priority should be, prepaying the loan for your land. And you must, it will be prudent to, prepay that loan or must pay that loan before you take another loan for doing the construction. Consolidate all your money, the money in the chit fund, the money in the recurring deposit, the money in the fixed deposit, and, the money which will be left after paying for your child's admission. That, you should keep accumulating it, prepay the land, pay the loan for the land, and then think of, having at least 10-15% margin before you take the loan for construction.
Well, Virendra, you did say that the money that she needs for her child's education, she should set aside. So let's assume the 3 lakh rupees that comes out of her bank deposit. How would you like her to keep this money aside? Should it be in a savings account, in a bank deposit for 1 year? Should she use a debt fund? Could you tell her what to do?
Maybe, she should take out 2,75,000 rupees, put it in a short-term bond fund or even a fixed deposit. The fixed deposit will be less tax efficient. So in a short-term bond fund, and I'm hopeful that, it should generate not as much return, but it will get pretty close to 3 lakh rupees.
Did you give her a name of a fund she can use?
The HDFC Super Saver Income Short-Term Plan or the Sundaram Short-Term Plan or UTI, any of the 3. These funds operate in a fairly narrow range.
Alright, so JAYALAKSHMI, what you have to do is find a mutual fund agent and that person will help you buy that particular fund that Virendra named. Then you go ahead and start paying off your loan entirely before you take on the next loan. And finally, Virendra, for her long-term goals, which is her son's higher education and her own retirement, for her and her husband, what should they be doing with that money? So let's move in the 1 lakh rupees from her LIC policy and of course the extra cash that she has to spare every month. Where should she be investing that money?
Ensuring that she is not missing out on any of the tax saving entitlement she has or her husband has, which is a maximum of 2 lakh rupee annual investment. So once the other important thing will be to methodically or have a very planned exit or a withdrawal from the ULIP plan or the LIC policy which she has, for which she is paying 1 lakh rupee annual premium. That money, in her case, I think, or in both their cases, availing that ATC benefit and the money which is left beyond the PPF contribution or EPF contribution, that should find its way into a tax saving fund, and one should exploit that 2 lakh rupee limit that will be available for both of them.
She has told me that she's a very conservative investor who's only ever used fixed deposits up till now. So she's going to use a tax saving mutual fund going forward. Would you recommend she uses a conservative fund? Which one would you like her to use?
If I have to choose 2-3 funds where one is investing regularly, I would say the one which comes straight to my mind is Quantum Tax Saving Fund. Everything else being equal, it will have half the expense. That apart, relatively more stable tax saving fund, Franklin India Tax Shield, or even something like Birla Tax Saver. They will be more stable options.
All right, Jayalakshmi, that's an entire plan for you that we've given you a quick recap. First thing you do, life insurance for both you and your husband. Take a look at your health cover as well. Then you put some money aside in a short-term fund like Dhirendra told you for your son's education next year. All the remaining resources you use towards paying off that loan before you take on another loan. And then finally, 3 tax saver funds on your screen right now that you can use for your long-term investments. Get back in touch with us if you need any help. If you're sitting at home and wondering how you can get your finances in order, write to us. Email ID is at the bottom of your screen. Dhirendra, we have one more question from another woman investor. Lopamudra Mahanti has written in. She's 26. We feel good when someone that young writes to us. She has 40,000 rupees every month to spare. She'd like to invest it in mutual funds through SIPs for the next 15 to 20 years. She wants to know where she should begin. She also asks, if the Sensex is at 20,000 right now, and she puts in money every month, what will her corpus be at the end of 5 years when the Sensex is at 30,000? She's optimistic about the market. Where should she start investing?
The worth of your money will be entirely a function of, your discipline, which is your investing every month, and the degree of volatility. If the market remains depressed for all these years, and it gains only in the 5th month, the last month of the 5 years, then you will have phenomenal gains. If the market goes up and down, you will end up, buying. So the return on investment is entirely a function of, how often you are investing and how volatile the market is. If you want to, get started, build confidence, and you're a little unsure, and you'll be very upset if you witness a 15% decline, then maybe, for next 2 years or 1.5 years, get started with a stable growth portfolio and then move your money into the aggressive portfolio. That may be a good grounding up, or, that will be a good warm-up to a market-related investment portfolio.
Lopamudra is very simple. The portfolio that's on your screen right now is easier to manage and it's more conservative. So if you feel more conservative about your money, you start off with this portfolio and come back to us when you need more help. Quick break. On the other side, it will be our product review. We look at the HDFC Tax Saver Fund. Don't go anywhere. Welcome back. You're watching Investors Guide and ET Now. Thank you for staying with us. It's time for our product review of the week. We're looking at the HDFC Tax Saver Fund. We'll find out if it's the best fund in its category and if we should be putting our money in this fund this year. Avan is here to first take us through the performance of that fund. Avan.
Thanks for that, Say. Well, our fund in focus is the HDFC Tax Saver Fund, which is known for its consistent performance irrespective of the direction that the markets take. In its 16-year track record, the fund has only underperformed the category average 3 times and has given returns of up to 29% since its launch. The fund takes calculated risks and gives average returns, thus suitable to a conservative investor. Despite doing well in different market cycles over the years, the fund is not a chart topper compared to its category average. Over the last 3 years, the fund's conservative stance has resulted in it slipping from the top 10 to the top 30 among tax-saving funds. But it has managed to beat the Sensex over the same period. Let's do some math to give you a better perspective. If you invested 1,000 rupees in this fund when it launched, you would have 23,648 rupees today. So should you choose the safe option or go for a top performer instead? Let's find out. With that, it's back to you, Faye.
Thanks, Avan, for that information. Virendra, HDFC Tax Saver Fund, not the top performer, especially if we look at the last 1 year, but the highest returns in this category were 30%, and this fund returned about 15%. It's been an average performer. So should we be betting on this fund?
Yes, not only last 1 year. In fact, over the last 3 years, this fund has struggled relative to, other funds. But when it comes to, beating the benchmark or being close to the benchmark but it has not been a disappointing fund. It has not been a disaster. And also the reasons are not very difficult to decode. It has kept away from the pricey segment of the market. Notable among that is, absence of Reliance or HDFC Bank in its portfolio. So I think that, the fund has taken a very conscious call, and I hope that it is right. If it is not right, after a full market cycle, maybe at some point it should translate into something material. But I think investors should hold on, because what we have seen that this fund has a very long history. It has shown its wisdom, and it has done very well over a period of time.
All right, Virendra, finally, your rating of the HDFC Tax Saver Fund, where would you place it?
I would say that it remains an above average fund and not necessarily the finest choice today, going by how it has performed over the past 3 years. I'll give it a 4 star.
All right, that's the HDFC Tax Saver Fund on Investors Guide. Let's move on to our hold or sell segment. Vikram Agarwal has written in, Virendra, he invests 18,000 rupees a month in his mutual fund for his son's education with a 3-year time horizon. He wants to increase that monthly investment to 24,000 rupees, and he wants to know if this list of funds is okay or should he be making any changes. Let's keep in mind the fact that he only has 3 years of a time horizon on these funds. Top of his list is HDFC Equity. Is it a little aggressive for this short time horizon?
Yes, it certainly is very aggressive. One should not be having an all equity fund, and of course it's not a very aggressive fund. I would not say that it's a mid-cap fund or something which could be very disappointing or at the time of your exit. But 3-year time is not good enough for you. If you need all your money after 3 years, then I would suggest that not have more than 15-20% allocation to equity overall.
All right, let's go to the rest of his list. He has the IDFC Sterling Equity Fund, Virendra. This is a mid-cap fund. Would you recommend it for such a short time horizon? Is it too aggressive for him?
No, not at all. IDFC Sterling Equity is an impressive fund. It's an impressive mid-cap fund, and it is a mid-cap fund by design. But for his time frame, it is a very unsuitable investment.
All right, next on his list are the UTI Dividend Yield and the Franklin India Blue Chip Fund. Now, he tells us he added the Blue Chip Fund based on your advice in December on this show. Now, given his time horizon, these are more conservative funds. Can he continue investing in these two?
Yes, these are conservative funds, and these are more desirable funds. They are unlikely to be, very disappointing for a shorter time frame. But still, I think 3-year period is not good enough. 3-year period is not good enough for a sizable part of your money going into equity. And these are the kind of funds which should be there in your portfolio for this time frame, and not the Sterling Equity and UTI, HDFC Equity kinds.
All right, last two funds on his list, the Kotak Gold ETF and the Birla Sun Life Government Securities Fund. Now, we have to remember that he's dividing his money equally across all of these funds right now. Gold is a bit of a risky bet for 3 years, wouldn't you say?
Yes, not only 3 years. I think gold has gone into a very different kind of spiral. We have said time and again that look at it as an opportunistic investment, or look at it as an investment where you are accumulating your savings to be exchanged for gold at a future date. As an opportunistic investment, I think the time is gone. If you're accumulating to be exchanged in lieu of gold at a future date, you can well carry on, which means that it should not be part of your 3-year investment time frame. Then comes, the fixed income fund. As I said earlier, that one should have a larger allocation to fixed income given your time frame, and that fixed income fund should be dynamic bond fund. It could be very opportune to be investing in those. A good part of your money should be in those, and it should not be a government security fund.
Okay, so you need the dynamic bond fund on that list. Virendra, can you very quickly give him a name of a bond fund, a dynamic fund that he can use?
I would like to name, quite a few, because one should have more than one of them, because that should be the dominant part of this portfolio. And if I have to list some, I would say the Birla Sun Life Dynamic Bond Fund or SBI Dynamic Bond Fund or UTI Bond Fund could be a reasonable choice.
So Vikram, that's the advice you're getting. Remember, a large chunk of your portfolio has to go into the 3 dynamic funds you see on your screen right now. Remaining 15 or 20% you can put in the 2 equity funds that the Rendra has approved for you, which is UTI Dividend Yield and the Franklin India Blue Chip Fund. Rendra, thank you so much for helping us with our investments this week. We look forward to having you back again next week. Coming up after the break, we will tackle those taxes. Don't go anywhere. Welcome back. You're watching Investors Guide on ET now. Thank you so much for staying with us. Let me bring in Suresh Sarana, who's going to answer all of the questions on tax. Suresh, thank you for joining us on the show. Our first question comes in from George Samuel. He's a senior citizen who's just moved back to India after 20 years overseas. He has a couple of questions about the tax treatment of his investments. He wants to know if his NRE deposits will continue to remain NRE deposits until maturity. He also wants to understand how he and his wife can split up the taxes between them so they can take advantage of that 2.5 lakh rupee, the cut that they both get. As far as his fixed deposits are concerned, he wants to know if he takes a loan against that fixed deposit, can he offset the interest against the interest of the FD? Now, given all of his questions and the fact that he's a senior citizen, can you give him a plan that he can use?
Yes, Mr. George, I think there are several questions. Let me start one by one. The first question is that whether as a person who was non-resident Indian earlier and was returned to India, are you liable to file the tax returns? So there is no specific exemption for non-resident Indians who come back to India. So if your income exceeds the taxable income, which will be 2.5 lakhs rupees if you are a senior citizen, you are liable to file the income tax return. However, if you have been non-resident for 9 years before coming to India, and then for next 2 years, you will still continue to have a status which is called resident but not ordinarily resident, which means your income earned outside India will not be subject to tax during those 2 years. So the only taxable income will be income earned in India during the 2 years immediately after you come back to India. Thereafter, your worldwide income will become subject to tax. The second question you are having is that the NRE deposits, once they mature, you cannot really renew. It will have to be converted into rupee deposit, or there are rupee denominated which you can convert back later on into exchange, but it has to be rupee denominated, and the interest on that will be taxable. The third thing is that in case you are, in case of husband and wife, in India here there is no concept of joint filing of return like in the US. So here each of you will be filing separate return of income. Each of you will be eligible for the deduction of rupees 2.5 lakhs or basic exemption limit of 2.5 lakhs rupees. And you can also claim ATC deduction, etc., whatever. So each of you will be treated as a separate entity. Your next question is that if you restrict your income to 2.5 lakhs from bank deposit, and you have the remaining investment in mutual funds or shares which are sold after 12 months, and which are sold through stock exchange, so in which case it is exempt from tax, whether you are required to file the return of income. So the answer is no. If you have income only up to 2.5 lakh rupees on bank deposit and remaining is either the long-term capital gain which is exempted or dividend income, then you are not required to file the return of income.
Our next question comes in from Shirish, who tells us his son has taken an education loan and begun repaying it. Now this year he's paid back about 97,000 rupees towards both interest and the principal on the loan. He wants to know if his son can now use this money to get that benefit under Section 88. Suresh.
Yeah, Mr. Suresh, first of all, it is not Section 88. It is Section 80E, which deals with the interest paid on educational loans. The second point is that the principal amount is not eligible for deduction. The interest amount is eligible for deduction, and it can be claimed as a deduction to the extent of whatever interest paid during the year.
The last question is from Rajiv, who writes in from Dubai, who opened a demat account from his NRE account. He wants to know if he trades in shares, Suresh, will he have to pay capital gains tax?
Yes, Mr. Rajiv, the short-term capital gain, that means whatever shares you are buying and selling within 12 months, will be subjected to tax. If you sell it through stock exchange, then the tax rate is 15%. If you sell it off market, then it will be the normal rate of tax, which could go up to 30%. So that is a tax liability for you.
Alright, we've run out of time. Suresh, thank you so much for joining us this week.
Thank you.
Remember, if you have any question about your money, saving, spending or investing, write to us. We'll be glad to answer it on the show. And of course, if you're a woman, we'll give you special prizes place. Email ID is at the bottom of your screen. Thanks for watching Investing Times.